Weiss+Associates presents Dealing with Income Tax Withholdings in Private Sector Corporate Jobs. Historically, most new information is challenged, not readily accepted, and is considered of specious origin. One only has to think back around 330 years when Galileo Galilei presented his scientific work that later proved that the Earth was not flat and that the Earth was not geocentric, the center of the universe. Galileo's announcement created an emotional firestorm in his day. He was persecuted for his scientific discovery by those who had known their entire life what he stated was contrary to the paradigm they grew up believing. Yet today, most people rarely give his discovery any thought, other than as an historical footnote that's the basis of all the evolved knowledge and research in astronomy. Such is the historical nature of mankind, which chooses to slowly believe new insights and initially classifies such new awareness as false, and thus must be strongly objected to. Today, we only smile and simply imply, "What was all the fuss about?" It all seems so civilized now. However, in his day, Galileo's discovery was a revolutionary concept that shook the capitals of Europe and challenged the preconceived paradigm that was the status quo in the 1600s. The information you're about to be presented with may come as a shock, appear to be false, or create a negative response by some private sector firms in their payroll or human resources department. Without any doubt, what you will soon discover is the truth and based on federal laws, which the vast majority of American private sector employers have never heard about nor studied. Many times, this paradigm shift in knowledge occurs in academic institutions of higher education where many might least suspect it to occur. Such is the repetitive nature of mankind when presented with valid concepts that alter the current status quo. One must first of all be open-minded enough to review the information. Then, one should verify its authenticity before moving to a conclusion. This is important due to the historical processes that invade the emotions even with those who know to use reason, even in light of what one may personally feel is an intellection that just cannot be true. The information will be presented and supported with legal facts so that the veracity of the new paradigm in every step that's presented can be substantiated. Factual presentment number 1. There exist two separate and distinct subsets or groupings in regard to federal income taxation. Perhaps it's best to start with a statement made by a federal appellate court. The site, as found in Westlaw, is 281 F 236, and the case is Long v. Rasmussen, May 29, 1922, in which Rasmussen was what we refer to today as the IRS Commissioner, but in that day the title was Collector of Internal Revenue. You'll find stated on page 2 of that federal appellate court document, in the left column and bottom paragraph, the following statement that establishes this as a clear fact. It was reconfirmed 50 years later in 1972 in Economy Plumbing and Heating versus the United States. You'll find the reference to A, taxpayers, and B, non-taxpayers. It's vital to understand both are legal terms, describing the former as one who has a legal obligation to file and pay the federal income tax, and the latter as a subgroup of Americans who are lawful non-taxpayers, free from any liability or obligation to file, pay, or to have their income withheld by private sector employers regarding the federal income tax procedures stated in Chapter 24 of the Internal Revenue Code regarding withholding. Verification of factual presentment number 1 is established by this federal appellate court in Long v. Rasmussen. The revenue laws are a code or system in regulation of tax assessment and collection. They relate to taxpayers and not to non-taxpayers. The latter are without their scope. No procedure is prescribed for non-taxpayers, and no attempt is made to annul any of their rights and remedies in due course of law. With them, Congress does not assume to deal, and they are neither of the subject nor of the object of the revenue laws. It's established by this federal appellate court that there are two subsets being addressed in this narrative. Only one of those subsets refers to actual U.S. taxpayers. What is not clearly presented is the proper identification of those who are lawful non-taxpayers. It's critical to note that there's no inference that such non-taxpayers are tax protesters, tax cheats, tax evaders, or the like. As you've just read, they're simply those to whom Congress does not assume to deal, and they are neither of the subject nor of the object of revenue laws, as they have no such liability for the federal income tax or the IRS procedures that create liability, such as Chapters 1, Income Tax Liability, 5, Income Taxes, and 24, Employment Withholding. Factual presentment number 2. Any federal income tax upon American nationals must reference the Rule of Apportionment. This fact is supported by the United States Supreme Court 1895 decision, Pollock v. Farmers Loan and Trust Company. The Supreme Court addressed the Income Tax Act of 1894, and it stated in the Government Printing Office publication on the 16th Amendment the following statement in part. The ratification of the amendment was the direct consequence of the court's decision in 1895 in Pollock v. Farmers Loan and Trust Company, whereby the attempt of Congress the previous year to tax incomes uniformly throughout the United States was held by a divided court to be unconstitutional. A tax on incomes derived from property, the court declared, was a direct tax which Congress, under the terms of Article 1, Section 2 and 9, could impose only by the rule of apportionment according to population. For the Congress to attempt to impose a federal income tax throughout the United States without the rule of apportionment being a component was declared by the Supreme Court to be unconstitutional. Verification of factual presentment number 2. Here, you see that a federal income tax created by Congress could only be applicable throughout the constitutional republic with the inclusion of a direct reference to the rule of apportionment requirement promulgated in the U.S. Constitution at Article 1, Sections 2 and 9, according to population based on the census and enumeration. The 16th Amendment, as it was written by the U.S. Congress, has the following wording that can be easily verified. The Congress shall have power to lay and collect taxes on incomes, from whatever source derived, without apportionment among the several states, and without regard to any census or enumeration. This amendment was written without consideration to what the Supreme Court stated in 1895 in the Pollock case, and it's created some confusion among the majority of Americans. It's noticeable that the Supreme Court did not challenge the 16th Amendment as being unconstitutional, and many fail to understand what actually occurred. Without doubt, the Supreme Court knew what it was doing, and so did the U.S. Congress. But, as with any great magician, the reality is not easily observed at first glance. Nothing changed with the Supreme Court decision that any avoidance of the rule of apportionment means that any attempt at imposing the federal income tax throughout the United States, meaning the constitutional republic, remains to this day as an unconstitutional act. We're now at a point that you need to keep your focus to follow the law that is now about to be presented to clarify this apparent confusion or misapplication of what the Supreme Court stated. Factual presentment number 3. The federal income tax was only levied upon the national government. You'd have to look long and hard on your own to find the foundational document that is the legislative intent of the 16th Amendment. Every law that a legislative body creates has a legislative intent of the law published so that future legislative bodies can look up the intent of those that created the law. You'd have to search the Congressional Record of the United States Senate on pages 3344 and 3345 for the letter that former President William H. Taft created on June 16, 1909, urging Congress to bring to life the 16th Amendment. It's only with the reading of this powerful document you can see what transpired regarding 1. The targeted audience, and 2. The jurisdiction for the application of the 16th Amendment. This was never stated in the text of the amendment for obvious reasons that will soon become quite evident. Verification of factual presentment number 3. President Taft stated in part in this most important of all documents related to the creation of the 16th Amendment. He stated the following. In the case of Pollock v. Farmers Loan and Trust Company was held by the Supreme Court to be a direct tax and therefore not within the power of the federal government to impose unless apportioned among the several states according to population. Here, you see his complete admission that the federal government was without any power or authority to impose a federal income tax unless it was apportioned throughout the several states according to population. Taft continued his statement to the Congress with, "The decision of the Supreme Court in the income tax case deprived the national government of a power which, by reason of previous decisions of the court, it was generally supposed that government ought to have." Admissions are rarely as clear as this statement. Here, you can see that former President Taft admitted that the national government was deprived of any power to impose the federal income tax throughout the United States. Before his concluding comments to the Congress, Taft stated just as clearly the targeted audience and the jurisdiction to which the federal income tax was only permitted to be made applicable within. "I therefore recommend to the Congress that both houses, by a 2/3 vote, shall propose an amendment to the Constitution conferring the power to levy an income tax upon the national government, without apportionment among the states in proportion to population." Taft knew all too well that he couldn't ask Congress to violate the Supreme Court's Pollock decision and attempt to impose the federal income tax throughout the United States without regard to the rule of apportionment, as that would be an unconstitutional act. A direct tax is rarely used by Congress as it relates to a one-time tax that's not self-renewing. The District of Columbia, the seat of the national government, is not a state of the Union, but a foreign jurisdiction to that of the constitutional republic. Therefore, the jurisdiction of the District of Columbia and its U.S. territories are located in a separate and sovereign jurisdiction, fully controlled by the U.S. Congress. The U.S. Constitution is not law within the federal territorial jurisdiction known as the District of Columbia. The Supreme Court's Pollock's decision is not applicable within this jurisdiction. The surprise to most Americans who read this information for the first time is that there are two separate and distinct jurisdictions. Also, that the U.S. Congress is not law within the federal territorial jurisdiction of the U.S. Congress. The targeted audience was initially directed toward those who chose to work for the national government, as that kind of work is viewed by Congress as a privilege, and privileges are taxable. Congress passes statutory laws every month that are applicable within the limited territorial jurisdiction, and most Americans make the huge mistake of assuming that those laws apply within the constitutional republic, and thus directly toward them. This helps explain why the U.S. Department of the Treasury states in 31 U.S.C. Section 321 D1 and D2 that the federal income tax is a gift or bequest made payable to and for the use of the United States. A gift or bequest is not a mandatory obligation, even when some Americans donate their earnings. Factual presentment number 4. The national government has exclusive jurisdiction over the District of Columbia. Kenneth R. Thomas, federal legislative attorney with the Congressional Research Service in Washington, D.C., created a memorandum on September 22, 1995, that addressed the congressional power to legislate. He stated in part in his memorandum that, "Among these many powers, Congress has been granted the authority to exercise exclusive jurisdiction over the District of Columbia. It should be noted, however, that there is no similar clause in the Constitution that gives Congress authority to exercise exclusive jurisdiction over the states. When Congress passes a law, there is no requirement under the Constitution that the Congress identify the nature or source of its authority." Verification of factual presentment number 4. One can easily read in Article 4, Section 3, Clause 2 of the U.S. Constitution to find that it grants congressional power over federal land and territories. The Congress shall have power to dispose of and make all needful rules and regulations respecting the territory or other property belonging to the United States, and nothing in this Constitution shall be so construed as to prejudice any claims of the United States or of any particular state. It's interesting to note the last sentence by Kenneth Thomas in his reference that there is no requirement under the Constitution that the Congress identify the nature or source of its authority. This helps explain why the 16th Amendment was written in the manner it was, and the confusion from the lack of requirement has allowed the sub silentio influence of the Congress to sidestep the Constitution in creating the impression that Americans are somehow subject to the 16th Amendment. The national government lacks jurisdictional authority over the constitutional republic, and therefore the 16th Amendment, as written, is only applicable within the exclusive territorial jurisdiction of the District of Columbia and toward those who are U.S. taxpayers. Those American nationals who live in the constitutional republic are outside the statutory United States, meaning the District of Columbia, and therefore have no federal income tax liability. Factual presentment number 5. The payroll deduction agreements like Form W-4 do not require private sector employers to withhold. The Internal Revenue Manual shows the following statement that is directed only toward those who are U.S. taxpayers. Keep in mind the Long v. Rasmussen decision that the federal appellate court that addresses American nationals as lawful non-taxpayers. The revenue laws are a code or system and regulation of tax assessment and collection. They relate to taxpayers and not to non-taxpayers. The latter are without their scope. No procedure is prescribed for non-taxpayers, and no attempt is made to annul any of their rights and remedies in due course of law. With them, Congress does not assume to deal, and they are neither of the subject nor of the object of the revenue laws. Therefore, the Internal Revenue Manual is only applicable toward those who are U.S. taxpayers. None of the statutes or procedures that the IRS comes up with addresses Americans throughout the 50 states of the Union who don't work for the national government. It's still worth noting for the benefit of the private sector employer that the Internal Revenue Manual states the following. Private employers, states, and political subdivisions are not required to enter into payroll deduction agreements. Taxpayers should determine whether their employers will accept and process executed agreements before agreements are submitted for approval or finalized. It doesn't get any clearer than what the IRM section states. Verification of factual presentment number 5. The Internal Revenue Manual subsection at 5.14.10.2.2 states, private employers, states, and political subdivisions are not required to enter into payroll deduction agreements. With this truth in mind, there shouldn't be any federal income tax withholding from the income of a lawful non-taxpayer, and there is no issue or pressure by the IRS for the private sector employer who elects to stop withholding. Therefore, if your private sector employer is inclined to compel any American national into submitting a Form W-4 against the wishes of that American, then it is the private sector employer that is incorrect. If such an act, which equates to a violation of God-given constitutionally protected unalienable rights of any American who chooses not to associate with the national government's income tax scheme, then this issue becomes far more than the private sector employer ignoring the request of their private sector employee. Unfortunately today, many private sector employers do not know, 1, the proper parties to which the federal income tax statutes are applicable, and 2, do not realize that there are two separate and distinct jurisdictions, both called the United States. Any IRS letter, such as Letter 2800C, advocating withholding of federal income taxes, have been designed to create the impression that the American national is a U.S. taxpayer. If that were correct, then there would never be any issue to discuss with the private sector employer. However, federal statutory laws promulgated in 26 U.S.C. are only applicable within the federal territorial jurisdiction of the national government toward those who are subject to the dominion and control of the U.S. government. If the private sector employee is not a legal U.S. taxpayer, then any attempt at compelled association is a direct violation of the 13th Amendment by the party creating or compelling an American national to accept a false state financial indentured servitude. Factual presentment number 6. The Internal Revenue Manual 6209 shows that Forms W-2, W-4, and 1099 are estate and gift tax forms. The IRS uses a tax classification system to identify the type of taxes and what they relate to. The IRS Forms W-2, W-4, and 1099 are described in detail in the IRS Manual 6209 to show that all these forms are related to estate and gift taxation only. When reviewing these IRS documents routinely used by private sector employers, one can locate them in Tax Class 5 information returns. These forms are merely information returns that are used by the IRS to create the presumption that the private sector employee is gifting their income to the national government. Verification of factual presentment number 6. The Internal Revenue Manual 6209 documents show that all Tax Class 5 information returns listed relate only to estate and gift taxes. This set of information returns allows the IRS to make a broad presumption without any factual basis that the party named on the form is a U.S. taxpayer. The Tax Class 5 forms are only information returns. If you look at these forms closely, you will not find any identifier as to the name of the person who created the information return. Additionally, you won't find any statement to the effect that might reflect something like, "This form is to be signed and dated by the creator of this information return. By signing this information return is an admission that the name of the party stated on the form is a U.S. taxpayer. This information return must be signed under penalty of perjury, punishable by federal law for any violation of a false representation that the party's name listed on the information return is not true and correct." If such a disclaimer was provided, it would eliminate the IRS ability for making any false presumption of federal income tax liability by being named on the form, and who would immediately create a liability for the private sector employer under penalties of perjury for creating a false document. Without that requirement, the IRS is free to make all sorts of claims against the party named on the Tax Class 5 information return. The IRS uses under penalty of perjury statements on all their formal documents, so why would they not use this kind of narrative for the private sector employer or other third party who creates the Tax Class 5 information return? The use of an under penalty of perjury statement would cause the private sector employer to actually stop and think about what they're doing and consider the ramifications of what they'd be exposing the company to by creating a false or fraudulent Tax Class 5 information return like a W-2, W-4, or 1099. The reason why they don't can be explained in part by the U.S. Department of the Treasury statute published at 31 U.S.C. section 321 D1 and D2. It's important not to overlook the opening facts regarding the nature and jurisdiction of the federal income tax scheme. 31 U.S.C. section 321 D1 and D2 states that the federal income tax is actually a gift or bequest and not mandatory. 1. The Secretary of the Treasury may accept, hold, administer, and use gifts and bequests of property, both real and personal, for the purpose of aiding or facilitating the work of the Department of the Treasury. Gifts and bequests of money and the proceeds from sales of other property received as gifts or bequests shall be deposited in the Treasury in a separate fund and shall be dispersed on order of the Secretary of the Treasury. Property accepted under this paragraph and the proceeds thereof shall be used as nearly as possible in accordance with the terms of the gift or bequest. 2. For purposes of the federal income, estate, and gift taxes, property accepted under paragraph 1 shall be considered as a gift or bequest to or for the use of the United States. A schematic diagram reflecting the status of an American national before filing a Form W-4 and after filing a Form W-4 is located in our Resource Center. If the private sector employer considers the left column and elects not to become a federal withholding agent, then the savings factor from accounting and mailing expense would be immediately converted to bottom line profits. In large corporations, this can be a huge cost savings, but it's still a savings to all sizes of private sector employers. Factual presentment number 7. Private sector employers are not required to participate in the IRS Payroll Deduction Agreements. By the federal employer acting as a withholding agent, that enterprise is identified in the Internal Revenue Code at 26 U.S.C. section 3401D to be a type of federal employer and a withholding agent by 26 U.S.C. section 7701A16. Prior to any such agreement to withhold, the private sector employer retains their original status of a private sector employer. Thus, the corporation, the private sector employer has volunteered by the IRS Revenue Code to become something that they are not, a federal employer. Then, that employer can be pressed by the IRS to abide by their dictates until that private sector employer rescinds their former decision to participate as a federal withholding agent. This schematic diagram shows the impact of the private sector employer acting as a withholding agent for the Internal Revenue Service under the statutory trade or business per 26 U.S.C. section 7701A26, which is defined as the performance of the functions of a public office. Verification of factual presentment number 7. It must be understood by the private sector employer that at IRM 5.14.10.2.2, there never was any obligation for the private sector employer to become a withholding agent. This section of the IRM deals with payroll deduction agreements, and it states in the 2004 edition the following narrative. Private employers, states, and political subdivisions are not required to enter into payroll deduction agreements. Taxpayers should determine whether their employers will accept and process executed agreements before agreements are submitted for approval or finalized. Now, the private sector employer needs to become aware of the fact that the Tax Class 5 information returns, Forms W-2, W-4, and 1099, are actually tools for the IRS to convert or compel an American national into being classified as a U.S. taxpayer merely by using this form. There are other methods the IRS uses, but for the private sector employer, this is the most unsettling of issues as they become a party to the violation of their employees' God-given unalienable rights. The jeopardy is that this is also an act that is a violation of the 13th Amendment, which outlaws slavery and involuntary indentured financial servitude in the constitutional republic. Factual presentment number 8. Americans have been obtusely defined by Congress to be non-resident alien individuals. This is a rather complex subject just by itself. It's important, however, so that the private sector employer can understand that the Congress is actually describing those Americans who were born in one of the 50 states of the Union or were naturalized there. Verification of factual presentment number 8. The first element of this topic is found in the Internal Revenue Code at 26 U.S.C. section 7701B1B. A non-resident alien individual is stated in the definitions section of the IRC as follows. An individual is a non-resident alien if such individual is neither a citizen of the United States nor a resident of the United States. Please read that statement again. Did you find any real definition as to what a non-resident alien individual actually is? Or did you merely find out what a non-resident alien individual is not? There is no identification of what a non-resident alien individual actually is. The second element of this topic is to understand the federal statutory definition of the legal term U.S. citizen. Immediately, many people laugh about this, as they're inferring that it defines those born in or naturalized in the constitutional republic. That is a presumption and not a fact based on federal law. You'll find the clearest definition of the statutory term U.S. citizen as expressed by this federal statute created by Congress at the American Journal of Jurisprudence. The citation is 3C Amger 2D section 2689, who was born in the United States and subject to United States jurisdiction. A statutory U.S. citizen is defined by the national government to be a person is born subject to the jurisdiction of the United States for purposes of acquiring citizenship at birth if his or her birth occurs in territory over which the United States is sovereign. The 50 states of the Union are outside the territorial jurisdiction of the national government. Those who are born in territory belonging to the United States are the real U.S. citizens referenced in the definition for non-resident alien individual in the IRC. Most Americans have simply never been told about this fact that has far-reaching implications. This is the reason we need to use the non-statutory term American national, so that there is no more confusion that was created by the Congress when the IRS uses the statutory term U.S. citizen. People who are born in Washington, D.C., or any U.S. territory, such as Guam, Puerto Rico, the U.S. Virgin Islands, and American Samoa are statutory U.S. citizens, subject to the dominion and control of the national government. It's important to note that they live without any protections via the Constitution. The third element of this topic to understand is found at 26 CFR section 1.871-1A. In this regulation, you'll find stated, non-resident alien individuals are taxable only on certain income from sources within the United States and on the income described in section 864C4 from sources without the United States, which is effectively connected for the taxable year with the conduct of a trade or business in the United States. However, non-resident alien individuals may elect under section 6013G or H to be treated as U.S. residents for purposes of determining their income tax liability under Chapters 1, 5, and 24 of the Code. Here's another one of those situations where most Americans think they know what the definition of the statutory term United States means. The key is not to assume anything in dealing with the IRS, so it's critical to look up each term, even if you think you know what it means. In the IRC, you find at 26 U.S.C. Section 7408D that the statutory term United States is defined to mean, if any citizen or resident of the United States does not reside in and does not have his principal place of business in any United States judicial district, such citizen or resident shall be treated for purposes of this section as residing in the District of Columbia. Unless stated otherwise in the IRC, all references to United States is only an expression to one who resides in the District of Columbia. They can reside there physically or by statute under 26 U.S.C. Section 911D3, tax home. Let's return for a moment and do some substitution of these statutory definitions to make out what's being stated so far under this heading to make it as clear as possible. Non-resident alien individuals are taxable only on certain incomes from sources within the District of Columbia and on the income described in Section 864C4 from sources without the District of Columbia, which is effectively connected for the taxable year with the conduct of a trade or business in the District of Columbia. The fourth element of this topic to understand is that a non-resident alien individual is an American born in the Constitutional Republic. Returning to the regulation 26 CFR section 1.871-1, we need to look closely at subsection B4, expatriation to avoid tax. For special rules applicable in determining the tax of a non-resident alien individual who has lost U.S. citizenship with a principal purpose of avoiding certain taxes. From the statutory definition we first looked at for the term non-resident alien individual, you probably remember that a non-resident alien individual is one who is neither a citizen of the United States nor a resident of the United States. With substitution for the term United States, it now reads one who is neither a citizen of the District of Columbia nor a resident of the District of Columbia. However, a question quickly arises. How can one be a non-resident alien individual who is not a U.S. citizen, but at the same time as stated here, be one who has lost U.S. citizenship? How can one lose something that they never had? The answer is quite simple, actually. The statutory definition at 26 U.S.C. section 7701B1B is only addressing those U.S. citizens as stated in 3C Amjur 2D section 2689. The regulation is saying that a non-resident alien individual is one who cannot be a statutory U.S. citizen. Additionally, those who are statutory U.S. citizens, as expressed in the American Journal of Jurisprudence citation, have no constitutionally protected rights, and they cannot expatriate or give up their statutory status as property of the national government, who controls every aspect of their lives. Only American nationals, those born in or naturalized in the constitutional republic, can choose to expatriate, and by doing such, will forfeit their U.S. citizenship by that act. They have the protections under the Constitution, and all federal officers, federal employees, and elected federal officials have taken an oath of office to protect and defend the Constitution, to which these American nationals are secured parties to that instrument. There can be no doubt that all references in the IRC to the term non-resident alien individual are only referencing American nationals, those born in or naturalized into the constitutional republic. Factual presentment number 9. Some non-resident alien individuals may choose to become U.S. taxpayers. However, non-resident alien individuals may elect under Section 6013G or H to be treated as U.S. residents for purposes of determining their income tax liability under Chapters 1, 5, and 24 of the Code. The Regulation 26 CFR Section 1.871-1A shows clearly that this is a distinct possibility. However, if they voluntarily chose to do so, they must do so with full disclosure of what the ramifications will be for changing their status. There also must be willful and knowing intent on their part. The election is a permissive act and not one of obligation, as you've seen by the information preceding this section. The word may is not an obligatory word, but rather a permissive one. Now, the national government has one more problem with this effort to convert American nationals into being one who is subject to the jurisdiction for the application of the IRC statutes. The Congress knew at the time this regulation was created, and all too well, that it cannot legally impose the federal income tax upon American nationals. The U.S. Supreme Court in the Pollock case and the legislative intent of the 16th Amendment made this fact very clear to Congress, and that's why they only levied it upon the national government and not upon American nationals throughout the constitutional republic. This is where the section in this regulation becomes very significant. Verification of factual presentment number 9. However, non-resident alien individuals may elect under Section 6013G or H to be treated as U.S. residents for purposes of determining their income tax liability under Chapters 1, 5, and 24 of the Code. The Congress had a real issue to not violate the Constitution and the decision of the U.S. Supreme Court, as such an act would quickly be rendered again as unconstitutional. So, they devised a scheme to convert American nationals who made the voluntary election into a new and confusing classification referred to as resident aliens. The reason why Congress chose to call American nationals resident aliens is clear. U.S. resident aliens are without a doubt a subgroup of U.S. taxpayers. Resident alien individuals are, in general, taxable the same as citizens of the United States. That is, a resident alien is taxable on income derived from all sources, including sources without the United States. Of course, this isn't what they really are, but by wordsmithing, the Congress has been able to circumvent the intent of the Constitution by nefarious and the highly effective use of words so as to not violate the Supreme Court decision at first glance. The national government also gave those American nationals who made the election the ability to leave the U.S. tax club at any time. This option has been there for them since the beginning, in the IRC. Congress just conveniently didn't tell American nationals where to look for the exit door for this income tax scheme. Factual presentment number 10. Non-resident alien individual personal services aren't deemed as income from sources within the United States. Non-resident alien individuals, meaning American nationals, who don't derive income from a federal trade or business in the District of Columbia, the statutory United States, shall not be deemed as deriving income from sources within the United States. Verification of factual presentment number 10. The Regulation 26 CFR Section 1.871-1A cannot be declared by the IRS if such income isn't effectively connected with the performance of the functions of a public office, meaning one who doesn't earn income from working for the national government. This was addressed earlier, but is worth repeating. Non-resident alien individuals are taxable only on certain income from sources within the United States and on the income described in Section 864C4 from sources without the United States, which is effectively connected for the taxable year with the conduct of a trade or business in the United States. Then there's a statute in the IRC at 26 U.S.C. Section 861A3 related to personal services, which confirms this fact. Certainly, if this is in effect in the District of Columbia, then it's also true that there's no liability for the federal income tax without the United States, meaning outside the District of Columbia. Compensation for labor or personal services in the United States, except that compensation for labor or services performed in the United States, shall not be deemed to be income from sources within the United States if the compensation is for labor or services performed as an employee of or under a contract with a non-resident alien, foreign partnership, or foreign corporation not engaged in trade or business within the United States. As a refresher, the statutory term trade or business means the performance of the functions of a public office. All public offices are created by Congress for those who choose to work for the national government. Since a private sector employee doesn't work for the national government, there's no requirement for the private sector employer to withhold any income for payment of the federal income tax. With the private sector employee not deriving any income from within or without the District of Columbia, there's no requirement for any IRC Chapter 24 withholding, as there's no public office that the private sector employee holds when employed by a private sector employer. As the schematic before W4 and after W4 shows, there's only withholding if one derives income that is effectively connected with the performance of the functions of a public office within or without the District of Columbia. That being the case, the private sector employer simply pays the private sector employee his or her entire salary, with no income tax withheld for any reason, including a letter from the IRS that does not comply with existing IRC statutes. The private sector employer can then avoid any accounting functions and other related expenses without fear from the IRS on this matter. Should the private sector employer feel the need, the private sector employee can provide them with a Form 8233, exemption from withholding on compensation for personal services of a non-resident alien individual. This is a fairly simple two-page form, with the private sector employer completing Part 4. Instructions for Form 8233 can be located online by performing a Google search. At this point, you must learn this material and then make the best attempt to educate your private sector employer as to the federal laws that exist. The distinction of those who are U.S. taxpayers and the jurisdiction to which the IRC statutes apply are limited. The law is clear. It's on your side. But we don't have any police enforcement authority to keep those in government from breaking the law. That's your job as a sovereign American by putting this information in your own words and getting the support of those in Congress to put pressure on the IRS if need be. You have to want it more than you're afraid of it. Learn this material and learn it well. Thank you for watching this presentation, and please subscribe to our YouTube channel to get further updates. For more information, please visit our website, weissparis.com.